Welcome, everybody, to the Everyday Investor. Today, I'm catching up with John Bolton and David Cunningham, both from Squirrel. So to start with, JB, let's start with you. Why don't you tell us who you are, how you fit into the world of finance, specifically mortgages?
So I founded Squirrel 15 years ago, predominantly as a mortgage broker, but more recently we've become, a deposit taker via a managed fund and peer-to-peer structure and a lender. So we kind of sit across that whole range of markets. Prior to starting Squirrel, I was a general manager of products at ANZ and ran a number of strategy roles and marketing and product roles across ANZ and Westpac.
Cool. And David Cunningham, for those that have been longtime listeners of the show, you'd recognize David from your cooperative bank days. But tell us what you're up to with Squirrel these days, David.
Joined Squirrel 2 years ago, so JB passed the mantle of Chief Squirrel to me. He's now OG, original gangster and founder. So, I guess we work together sort of running the business. JB focuses on advisory. I focus on sort of the savings and investment side of the business, writing blogs that are informative, hopefully, for New Zealanders, often with a different perspective, and all the governance stuff. We're a publicly unlisted company with 300 odd shareholders, so there's a whole lot of that good stuff to do, and keeping regulators happy. So, a bit of everything.
Yeah. Okay. Well, when it comes to taking out a mortgage to buy a home, whether it's a home to live in or whether it's a property that you want to own for a while to make some gains, when it comes to how the banks come up with their rules on how they lend money, sometimes it doesn't feel fair, and those with the gold make the rules, right? What have you guys noticed? Like, JB, you've been doing this for 15 years now. So over that 15-year period in particular, what have you noticed in terms of the evolution of the rules that banks follow?
Good question, Darcy. It's interesting because I was an executive at one of the big banks, sitting up in the ivory tower, trying to get the business more customer focused, and I think we're doing a reasonable job of it. And now I'm at the other end of it, where I'm dealing day to day, face to face with customers, and seeing how frequently what I think banks make poor decisions. There's a real disconnect there, because I think if you went to the upper echelons of the bank, I think they would actually be somewhat disappointed with the way that they're executing with the customer at the front line. It's a very tricky business to run, right? They're very big businesses, very complicated businesses. I think there's a real gap between what's happening upstairs in terms of strategy, compliance, regulation, and then how that flows through these organizations down to the actual customer interactions. And, so I get frustrated. I sit there and I go, my God, how can these banks be making such, poor decisions? And I feel that as an advisor, and occasionally I've kind of rang up ex-colleagues and stuff to sort of say, guys, what's going on? And I get myself in trouble because, advisors shouldn't be doing that. But I just get frustrated. And, really good example of it, just to land that, would be triple CFA.
Mm-hmm.
So obviously a couple of years ago, Labor put through a lot of changes on triple CFA to sort of tighten up the regulations, get better quality lending done. And there was a problem there that needed addressing, right? There's a problem with loan sharks, consumer finance lending into people that simply can't afford it. We all know it's a problem. We all know that we need to find better solutions for that. But triple CFA pretty much sort of as a broad brush that covers all customers. And people listening to this podcast by now would have experienced the results of that, right? Which was suddenly everyone was being treated like children. You had to literally go through infinitum at a transactional level every aspect of your life. And it was crazy. Now, I know National's starting to unwind that. But look, the reality is, if you actually went into the detail of triple CFA and the responsible lending code, there was an ability for banks to step above that and to be more pragmatic. They just didn't. And I think that's where Labor kind of, or the government at the time, kind of misunderstood this, because banks are inherently conservative. They're always going to take a very clean approach to things. They're always worried about the risk and the disconnect between upstairs and the front line in their businesses. So you're always going to get them taking a very literal interpretation of what they're told to do. And that's what we saw. I actually think that the regs had a degree of flexibility in them that the banks didn't apply because they are risk adverse by nature.
And to add to that, regulators can be quite scary, as we've seen with a lot of self-declaration of problems that entities have identified, and you don't just get having to pay back the money to the customers. You then get taken to court and fined a few $1 million, and so there's a real natural risk aversion in those large organisations. And JB's point is that the regs arguably were flexible, but actually it's got to be black and white. Because banks will go to naturally anyone regulated will go to the sort of the least risk outcome. So yeah.
I remember having this conversation with you, John. Like, must have been in 2022. I think we were having a chat around the triple CFA. So for those that need an explainer around that acronym, the Consumer Credit Contracts Finance Act. Is that correct?
Yeah.
Cool. So when that came out, I remember you were fairly critical about this at the time. I probably went a little bit further and suggested that bit of legislation was actually being used to bring the property market down on purpose. They knew it would cause this collateral damage, and that was actually the point. As well as all the other stuff, that was obviously a bit conspiratorial. Now it kind of feels like, hey, that's being removed for good reason. Take us through what's happening, though, with the triple CFA. So we have some pretty serious changes coming up, right?
Well, I think it's still pretty high level at this stage. Look, we actually got quite a bit shifted at the time, because I put a petition in, obviously, to Parliament. It was so bad. It was so badly executed. But at the time, we got them to step back quite a bit. Not as far as we would like, but we got them to step back. The way I describe it at the moment, I don't think it's restricting lending much. There is still a little bit of collateral damage, but it's not restricting lending too much because of the high interest rates. The high interest rates fundamentally the thing that's holding the market back, right? So I don't think suddenly you change this and it goes crazy out there, because it simply won't. But it will make it less painful for people. It won't feel like they're getting interrogated quite to the same extent that they might at the moment. There are bigger issues with triple CFA. So I'm hoping it's more than simply sort of retracting what was done a couple of years ago, and it's a bigger, more robust review around, is this piece of legislation fit for purpose? Because fundamentally, triple CFA was designed for consumer finance lending, and I think it's not really fit for purpose when it comes to mortgages. And one of the things that we've got to remind ourselves is that New Zealand's a country of small businesses. Small businesses, at the end of the day, leverage their house to get working capital. The house and the mortgage is much more than simple consumer finance lending. They use it as an ATM to buy another car or this or that. Sure, that might happen, but this asset actually plays a much bigger role in our economy.
Mm-hmm. Yeah. Let's now, I just want to maybe pivot and talk a little bit about the macro-prudential regulation piece, or the fact that we have a Reserve Bank of New Zealand, and then we have the commercial banks that we would deal with, like ASB or ANZ, et cetera. And there's, again, different conversations that you're going to have, different sets of rules that you need to tick the boxes against. And there's three primary things that we're already subject to when it comes to the Reserve Bank of New Zealand. First thing is interest rates, official cash rate, OCR, that affects interest rates a little bit. Second thing is loan to valuation ratios, which is determining how much deposit you need. And then thirdly, the one that I wanted to peel back the onion layers on a little bit is the debt to income ratio, which is more of an income testing tool. So these three things, two of them are already in place. This third one that's coming in place is designed to limit the amount that you borrow, so that if you're an owner-occupier trying to get a mortgage, you can only ever borrow 6 times your income. If you're a property investor, you can borrow 7 times, including the rental income. First question I have for you guys is that actually necessary? Do we need a debt to income ratio?
I was very anti-DTIs probably 18 months, 2 years ago. I've probably come around a lot on DTIs. I think they're probably a better tool. than I probably gave them credit for in the past. But one of the interesting things is, the Reserve Bank's been talking about, okay, debt to income ratios. We want to make sure that people are only borrowing as much as they can afford to borrow, right? Now, arguably, banks do a good job of that already. But let's accept that principle. Then they're saying there's an exclusion for new builds. And we put this into our submission. How can you exclude new builds from something that is based on affordability? How can you say it's fine, yes, we're going to put DTIs in, because we want to make sure people can afford the debt, but if you're buying something new, we're going to exclude you from that calculation? It's totally inconsistent, mate. It doesn't make sense, right? Because the Reserve Bank's doing two things here. One is it's trying to hold house prices back, but it's wanting to encourage new build activity. And it just feels like it's inconsistent. It feels very inconsistent, to be honest. Felt maybe more consistent when they were talking about LVRs. But I don't think the Reserve Bank's really been as transparent and open about what it's doing as I feel it should do, under this macro-prudential framework.
Yeah. What are they doing?
I think they're ultimately trying to control house prices. And but you'll never hear them say that. And that's the only reason that you could exclude new builds from a DTI framework, because I see no logic in saying that someone that's buying a new build has got better affordability than someone that's buying an existing property. It just doesn't make any sense.
A little bit of mission creep, then, is what you're suggesting.
Yeah, I mean, all these frameworks tend to have a sort of a limit and then a allowable buffer, upon which you can operate. So, like with LVRs, it was sort of an 80% LVR, and you could do lending above that. And I think it's now 15 or 20% of a bank's lending can be over that level. And so that is probably where the flexibility should be, not in saying, but this is excluded from the whole conversation. And, that just creates A, complexity, and B, it gets like almost a political sort of interference, like want to build more houses. We'll fix that by making your land more available, not trying to suppress house prices, because supply and demand does supply and demand things, right? It's, hundreds of years and it's not going to change. So, fix the underlying problem. And in many ways, some of these things are sniping at the outcome, ambulance at the bottom of the cliff rather than the fence at the top of the cliff, which is having regulatory settings right in the first place. And also trusting private enterprise to do what's right. I mean, yes, banks will, their business is based around managing risk. Losses on home loans for the last 20 or 30 years in New Zealand have been a fraction of 1%. So why have all these restrictions? Is that because banks aren't doing a good job?
Well, that's kind of what it's implying, isn't it? It's like this pendulum swings, doesn't it, between the loss of trust in the private sector because they're doing dodgy things, and then it moves back to loss of trust in the public sector because they're so disconnected from reality. And it kind of feels like that pendulum now is swinging away. And now it's like the public sector, the regulators, people are starting to be aware of what's going on and look at them. Like here's the question, I guess, like, do you think that you mentioned unintended consequences before, John? Like, do you feel like with debt to income ratios, it's going to create, or at least has the potential to create, a whole bunch of feedback loops and complications later on?
Yeah. And look, we've flagged some of those to the Reserve Bank in our submission. One of the big problems that we've seen with DTIs is that it's applied at a customer level, not an individual security level. So whereas with LVR restrictions, it's property to property. So, the client could have a property with one bank that's at 60%. It could have another one with another bank that's at 80%. And we don't have to get concerned about sort of cross-contamination across lenders. When it comes to DTIs, the DTI rule is going to be applied across the customer's entire portfolio, because whenever any lender looks at it, they're not looking at a property in isolation. They've got to look at it at a customer level. So what it means is that you get one response from a bank, you're going to get the same response from all banks. And whereas with LVR restrictions, you might be, okay, well, I'm going to go sell this property so I can release some cash to go and do this thing over here. Suddenly with a DTI framework, that doesn't work anymore. And I think that's going to create a whole lot of unintended consequences, because people are going to find themselves getting trapped in situations that we're unable to dig them out of, or we can, but it'll be horrendously expensive, because it won't be a simple take this property, move it over here. It's going to be we actually have to solve everything all at once. The other outlier in this space is new builds, because we find this with LVR restrictions as well, is that it's a new build at the time that the credit decision's made. But after they've owned the property, when does it stop being a new build? When do you change the way that you're viewing that property? So if we go, this is where I was saying the exclusion on new builds makes absolutely no sense, because I could buy a property as a new build, and everyone says, oh yeah, that's cool, it's exempt from the DTI calculations. I go, cool. 6 months later, something else is going on in my world, and they're like, oh, no, we've got to now add that in. It's no longer a new build. And so suddenly, oh, you're outside of your DTIs. We can't do anything for you. Sorry, can't help.
Wow.
To be fair, though, the point of the what do they call it? You've got your sort of speed limits, and then your buffer sort of around that. And so, I think the Reserve Bank intends initially those allowable over the 6 or 7 level to be, I think it's 20% is what they're proposing. Yeah. But of course, what will happen is, through the cycle, when they want to tighten things up, they might reduce that to 5% or 0%. And it's that time when we see, what JB just described as having a real impact. So, so long as there's a big buffer, no issue. But when things are tightened, that's when real issues will arise. And of course, in those situations, no one will do the sort of lending. So, the solution is not to have exclusions that will come home to bite. Keep it general, very, very broad based. It's just like, GST is broad based. Everything's GST, right? Do the same with us. Don't have this bit out, and the argument for don't have GST on food. All it does is open cans of worms. And in some ways, what the Reserve Bank's doing here is not having GST on food, the equivalent to mortgage lending, and that's a bad idea.
So, I guess when we think about some of the unintended consequences, just to make that really super clear how important this is, already, I guess any mortgage advisor would be like this, but I'll field calls 2 or 3 a week from people that have got themselves into a spot of bother selling a property. They might be property investors usually, and they're selling one property on the expectation that all they needed to do was to pay down the loan account that was used to buy that property. And lo and behold, they go to the bank and discover that all of the net proceeds after real estate commission have to go towards reducing debt in their entire portfolio. No one tells the borrower that risk is happening, and the rules actually potentially would have changed since when they signed up for that mortgage and when they got rid of that mortgage. It used to be that you could just do that and take out the cash and off you go, do what you want with it, do the renovation, right? Start the business or whatever. Is that going to be more of that, do you think? Is there going to be more conversations where at the bottom of the cliff, accidents already happen because no one's really out there educating the public of what's going to happen when these rules get put in, right?
You're right. Look, to be honest, the LVR one's probably, that's been around since time immemorial. And I don't think there was so much LVR restrictions. That it's always been the case that lenders will cross-collateralize securities, and people are unaware of what that means. And then when they go to sell a property, they go through another credit decision, and then the bank takes the full proceeds, right? I remember that happening back when I first was brokering in 2009, so well before we had LVR restrictions. I think the real risk with that is when you've got falling house prices like we've had in the last year or two, and you've got high interest rates and a lack of affordability. Banks, literally now, we're seeing this problem quite often, where people who thought they were in a good position and everything worked suddenly are finding it's not.
I guess, Darcy, a sort of outcome from all these sort of rules is that the importance of an advisor becomes bigger. It used to be you go to the bank, it was simple and so on. And so, today we're seeing, for some of the big banks like ANZ, well over 60% of all their mortgage lending is done through an advisor. And for the industry, we think it's about 55% at the moment. In Australia, it's almost 80%. In places like the US, 90% through a broker. And I think when you think about New Zealand, there's been a big change in that in the last, it was consistently 40%. It's probably nearer 60 now. And I think part of that has been the complexity from the Reserve Bank and rules and legislation, for one. And then the second thing is that banks have sort of outsourced distribution to mortgage advisors as they've scaled down their sort of teams. But I think the insight is, people that are expert in this space, which is unlikely to be an individual banker, at a bank are actually really important if you've got anything other than the most vanilla sort of lending.
Well,
So
I think
advice.
I think the other thing that I was going to add to that, Dave, is that New Zealand historically was quite a homogenous market. We've got four, maybe five, major banks,
Mm.
all doing very similar lending, all similar credit policies, all similar pricing. You're right. Historically, a lot of it used to go through the banks themselves. I think historically Kiwis were quite simple with the way that they approached mortgages. It was largely rate driven. And I think one of the big mistakes that we've seen over the years, but it's been very hard to wean people off it, is that, look, the simple reality is if you take your entire property portfolio, roll it into one bank, they're going to give you a pretty sweet deal, right? You're probably going to negotiate a better overall rate, and you're going to get a bigger cashback. And when everything's good and everything's good in the world, no one really cares, and it's very price driven. But I think we're seeing now that putting all your eggs in one basket is not a great idea. There are costs and consequences of that might not have been visible when everything was great. But is certainly coming home to roost now. So it's interesting because I think Kiwis have changed. I think people really do understand that there's a lot more risk out there, whether it's regulatory, because of stuff that the RBNZ's doing, or simply the state of the economy, falling house prices, whatever it is. I think people are a lot more realistic now about the fact that they need to manage risk. And I find when I'm dealing with clients now, the conversations are very, very different to what they would have been 10 years ago.
Totally. And people seem to be increasing their knowledge and awareness of just money in general. And so it becomes almost easier, right, to have a much more meaningful conversation, strategic, and you can start to dig a little bit deeper, which is really cool because you can start to help people who are taking wealth seriously do a better job of it. So
Yeah.
on the topic of risk, though, this whole risk thing is something that I've been mulling over in the last 2 days in particular. With a lot of the regulation is designed to keep us safe, or that's how it's at least packaged, right? And I guess that makes sense. But there's two things going on here with how the Reserve Bank is operating. They are trying to create financial stability within the household. Well, that's my take on it. I could be wrong, but it feels like there is this genuine attempt where they're trying to make sure that households are more resilient and they can handle shocks, and therefore reducing the amount that they can borrow makes sense because if interest rates go up again like they are right now, then people will be less exposed. That's great. But there's also this systemic piece, right? Where there's this financial systemic concern that could happen if people get over leveraged. And sometimes that doesn't come out very clear. Like when the Reserve Bank is doing and engaging in their macro-prudential regulation, do you feel like they are more or less trying to keep the system safe or households safe?
I think Reserve Bank's very much about the system, whereas things like the legislation, like the Credit Contracts Act stuff, that's more about protecting the individual. Of course, the sum of the individuals is the system, but I don't think the Reserve Bank's, trying to save individuals from themselves. I think they're trying to save the system from the weight of individuals collectively being overexposed. So I think it's really clear. Legislation is, protecting the individual. The Reserve Bank is about protecting the sort of stability of the financial
Perfect.
system.
And I think I was going to add to that, Darcy, and you hear the Reserve Bank say this from time to time, is that, no one, no one begrudges. Well, I guess no one's really supportive of a really strong financial system until it's not strong.
Yeah, the saying I think I might have said before is, the only thing worse than a profitable bank is a loss-making bank.
Yeah,
So
yeah,
we
yeah, yeah.
begrudge sometimes the high returns on equity and all that, but
Yeah.
better than losing, as we've seen the world over many decades. And so,
Yeah.
in the Reserve, in Australia, the Reserve Bank or the APRA, the Australian Prudential Regulatory Authority, talks about unquestionably strong. In New Zealand, Reserve Bank says 1 in 200 year risk of failure. Hopefully, that's not not like the 1 in 200 year floods, which
That's
can
right.
happen every other year. But they've set the capital threshold very high, and arguably you don't need such tightness in some of these other settings, given those very high levels of capital. It's just like the industry's arguably being bombarded with multiple things that create a will never fail sort of type outcome.
Yeah.
which is sort of interesting because that probably leads into this whole conversation about competition in the financial services sector, because it's an oligopoly, right? It's really, really high barriers to entry, because firstly, you've got to build the trust of your customers to attract them to you. Then you've got to have a value proposition that's way better than what they have. And banks in New Zealand do a pretty good job. The only successful newly launched bank in New Zealand in the last 50 years is Kiwi Bank. And that had, government support, wide distribution network through Kiwi Bank, and all these things adding up to make it a really hard industry to break into. And then we wonder why there's not a load of competition.
And there kind of needs to be profit in New Zealand because the money takes longer to get here on ships, right? So I get
I mean, if you sort of think about the Commerce Commission inquiry, I mean, really, did it say anything? I think when it was launched, I sort of think I wrote an article saying it would make diddly squat difference, and let's be real, it ain't going to make any difference. The Reserve Bank's already pushed back on their draft recommendations on capital levels and things like that. Open banking is doing its thing. That's more of a government-driven thing, but open banking doesn't change the world, to be honest, that much or that fast. So we're stuck with an oligopoly, and I guess at Squirrel we sort of stick up for New Zealanders in terms of arguing for slightly different outcomes. But that said, the banks do a very good job, and in New Zealand the customer experience is pretty good. So it's not a broken system, but it's a very profitable one.
It's not perfect, but it works, right? So going further up the chain, though, and just kind of understanding this from a risk point of view again, do you see that there is any problems with more centralization that's occurring here? Again, going back to the fact that the Reserve Bank of New Zealand already controls the interest rates to a certain degree. They control how much deposit you can use, and now shortly how much income you need to borrow. Do you see any risk that there's one authority, really?
Yeah, I totally do. And hey, look, there's another thing. It's called the Banker's Handbook, and it's not a public document. But look, the Reserve Bank actually has way more influence over bank policy than simply interest rates, servicing and DTIs. They have pretty close look at a broad range of credit rules and how that's been interpreted and managed by banks. So, whether it's foreign buyers and how they're treated, or the servicing rates that banks are using, whilst the Reserve Bank doesn't directly regulate the actual number the banks use, I tell you, they have a pretty significant influence over it.
So where can we get a copy of this, the Banker's Handbook, John?
It's one of those secret documents that doesn't really exist. But look, they do have a lot of influence. My concern is it's a bit like pine trees. This is a random JB analogy, but the problem is that, you end up with pine trees that are the same genetic strain, and the risk is you get a bug into the system and we wipe out entire pine forests. Well, what the hell is that going to do with banking? But look, the thing that I would say with our big banks is as a market, we are dominated by our big five banks, right? I think, I forget the stats, but they control over 87%, I think, of the market, right? And so the concern that I have is that they're very homogenous. Like, if I lined up all of the banks next to each other, they almost look identical. Now, we criticize the pricing and we say they'll price the same, they're an oligopoly, but it literally flows through to credit policy as well. And so, when you have a system where you've got your five big banks are literally controlling the system and they all act in sync and they're all the same, the risk with that is it diminishes innovation. But more so, I think it limits the economy. It limits, people that are on the edges of what is considered, the mass market. And so you don't get good development of policy for niche markets, and I think this applies to consumer and to business. And I think there's been a lot of criticism in New Zealand, particularly in the SME market, that this is what's happening, right? We've got banks that zig and zag together. The policies are all the same. It's a homogenous beast, and it's not allowing for businesses that are maybe innovating and on the edges of that to get the capital that they need.
I think, I stand back and say, well, there are two sort of issues here. And one was highlighted in a great article in the AFR recently, which talked about New Zealand needs a maverick bank like Australia's got Macquarie Bank. So Macquarie has grown, it's not well known in New Zealand, but it's grown from 0 to 5% of the mortgage market within a few years. And that's an extraordinary pace of growth. And they've, I guess you could say, almost single-handedly suppressed margins and therefore profits for the banking sector as they've built out a largely digital business with broker distribution at its core. That's one thing. The other thing is the non-bank sector isn't big in New Zealand. So this is the not the second tier banks, but the level below that, those that aren't banks. So, Squirrel itself does a bit of lending in this space, but that second tier sector isn't big. And one of the issues is when banks all tighten, then that sector opens up in terms of opportunity. And then when banks loosen policy, then suddenly the bank can do it. And so those guys write almost no business for a period. And so, and part of that is just through the interest rate cycle, banks can manage their profitability from either deposits or loans, whereas a second-tier lender is typically funding in wholesale markets. And so you sort of need to build a retail base like banks to compete. But, the absence of those second-tier lenders and a maverick sort of bank is the competition issue in New Zealand. And it's hard to see what will change unless a Macquarie decides it's going to come to New Zealand and go for it. Kiwi Bank is becoming more and more big bank looking in some ways. We like them and they're relatively price competitive at times, but ultimately, what does the shareholder want? A good return on equity. And the model is the same. I've got branches, I use brokers, they all look the same.
Well, arguably, it's a bit like the managed fund industry, right? There's been a similar criticism labelled there, which is in fact, they want to zig and zag together because no one really wants to stand out from the pack, right? Mm-hmm. I recall a few years ago, one of the banks changed their credit policy on small apartments up to 80%. They got absolutely slammed with business and backtracked on their policy pretty quickly. Within months, I was like, oh, shivers, we're getting too much exposure to small apartments, because suddenly they owned that market and they don't want to do that, right? They just want a little bit more than their natural share. And so they backtracked on their policy and probably put that market back sort of 5 years.
Interesting, because I guess that has an impact on prices, right? And that's, again, we're back on the topic of unintended consequences, right? Like, you change the 100%. Rules from the very top, even at the bank level, and then what you're doing is you're redirecting the flow of money to move into certain sectors, whether it's at the economy level or whether it's even just within the subtypes of different security properties that the banks will lend on. So banks effectively control property values, which is a pretty bizarre concept, but they do. They control property values using interest rates and criteria, the price of money and the availability of it. Is that too much of a simplistic view, though?
No, I think you're entirely correct. I mean, look, let's be honest. Credit determines house prices fundamentally.
Yeah,
it does. It does. And over the years, easing credit in one shape or another has driven up house prices in the Western world. And I mean, you're crazy. You just can't argue. It's just such a strong connection. Now, the single biggest connection there is interest rates, because ultimately, or servicing rates, the servicing rates that the banks apply. But everything does. All of the credit policy, whether it's LVRs, it's policy for this type of asset or that type of asset, it's ultimately going to flow through into the price of that asset. So, which was back to the point that both of you guys have made earlier on, which is, to some extent, I think, a lot of what's happened in the last 5 or 6 years has been to, indirectly control house prices.
Yeah.
The perfect example of what to do right is exactly what happened after the Christchurch earthquake. Land was freed up. Guess what? A decade later, we're still seeing the benefit of that. A typical house in Christchurch costs, for a first home buyers, 500, 550,000. In Auckland, it's double that. And there's only one reason for that. It's because land was made available. Builders were brought in from the Philippines who were damn good workers. They lived in hostels. They didn't take up more houses. They've become New Zealand citizens over time. It's so easy. And there's a living case study, and we can see the benefit from it. And all this sort of stuff that the Reserve Bank's doing would be unnecessary if policy was right in the first place. And we've got the living case study, and I've told ministers of finance this over a decade, and I just don't get why, what makes it so hard to act on that. And I think what we're seeing is possibly the new government is getting into the nuts. They're getting rid of overreach of bureaucracy, but they've got to get into the right policy framework in the first place. And not everyone likes it, but that's a government's decision. They're elected to make big decisions, and that's what will fundamentally change economic outcomes for New Zealand, is those big decisions. And this has been something that's been wrong in New Zealand for probably 4 or 5 decades.
Yeah. So it's policy. It's something that maybe in the past we've had kind of two parents: the Reserve Bank, government. The government's kind of been, you do the heavy work, Reserve Bank.
Yeah.
We don't really want to, but now that they really have to pull finger, get on with it, because there's only so much that you can do to the demand side to suppress demand, to make it fall within line. We actually have to deal with a supply issue so that the prices are actually, again, it's too much, it's overreach, it's too much regulation, it's unintended consequences, it's all that sort of stuff that comes into play.
House prices in Christchurch are still half what they are in Auckland, despite that. So that's sort of another small element, but the bigger issue is availability of land. And if you had plenty of availability of land, you'd also have large construction firms, the likes of the Fletcher's buildings, building 1,000 sort of size subdivisions, whereas in New Zealand you tend to have sole builders, which are really inefficient from a cost perspective as well.
Okay. As we come in for landing, I want to ask your opinion, and this is very early stage, so this is going to be probably something that we'll look back on and reflect on and go, that was interesting how I had that view back then. I know for me, there's been a couple of things that I've been aware of in terms of my own views, and I think, wow, like just seeing how much things have shifted over time as you learn more. Central bank issued digital currencies, CBDCs, is a phrase that when you throw it out there, still people do not know what you're talking about. You're a tinfoil hatter. That's not real. Of course, the central bank would never want to get involved with money and telling us where we can and cannot spend. But now we've seen this. We've seen a little bit more communication out of the Central Bank of New Zealand, the Reserve Bank of New Zealand, with digital cash. And I was wondering what the brand name was going to be so people wouldn't freak out. But digital cash, what are your high-level thoughts, good, bad, or otherwise, right now?
For me, one thing, it's simply what we've got today called electronic payments. I tap my phone, it happens, but it's anonymous. It's the only difference.
Yeah.
Of real substance. When you've got a secure banking system where banks aren't going under, the Reserve Bank can provide that facility in the form of a digital sort of currency. But, there's no sort of, it's all about anonymity, in my opinion.
Okay.
Yeah, I'm slightly different on that. Look, I like it. I think it allows for a more decentralized sort of payment system that's not reliant on the same network infrastructures that we've got today, because it doesn't have to pass through the traditional bank rails. It's going to operate off the back of a lot of the technology that's obviously being built in the crypto space. So I think it's a really positive thing. I think it will create significant innovation, and I think I'm really positive on it, and I think there's some pretty significant consumer benefits as well, just in terms of I'm going to say UX, the ability to more tightly tie the actual payment to the thing that you're doing. And I can give you an example of it that I experienced in China when I was there recently. Theirs isn't a digital currency, but they obviously haven't got traditional sort of payment rails over there. So you've got WePay and Alipay, and they use QR codes as a mechanism to facilitate what would traditionally happen for us over an FBOS network. But what was really cool was I was walking past a poster of a DJ they had a gig on that night. They had a QR code on it, and I could click the QR code on my phone, bring up a ticket and pay for it, and have the whole experience totally wrapped up in that single transaction of, hey, what's this? I'm keen to go, done. And, if you think about how that would work for us, through an FPOS network, yeah, sure, you can do something similar, but it's got a lot more friction in the process.
Yeah, so, one of the problems is that the current system isn't real time. Banks make it look sort of real time, but then you look at your bank statement, it says pending, and then the transaction comes through on Monday or Tuesday or something. So, I think what a digital currency, including the existing ones that are out there, they ultimately drive real-time transactional sort of activity. It forces the banks to sort of catch up. But, banks aren't going to leave this to others to do the job. They'll catch up, they'll partner, they'll sort it out because they're out to protect their patch. So I guess what it does is drive innovation and get the banks moving along, because they need kicks up the bum sometimes. The whole scam thing in the last sort of 6 or 12 months is, they could have done all the things they're doing now 5 years ago, but it took sort of public noise and action that to get them sort of collectively moving in the right direction. So, positive in the sense of it drives change.
I think the other piece to it for me is that crypto has, we can all debate crypto for hours, and you probably have, Darcy had plenty of sessions on crypto, and this idea of whether it's a true sort of means of exchange and that it holds its value, it's reliable, and it's consistent and stuff. Fundamentally, digital currency is leveraging the underlying infrastructure. It's a stable coin, basically, right?
Mm-hmm.
And but it's a reliable stable coin backed by the government or by the Reserve Bank, and so I think it's got all of the characteristics you want to see in money, with the technology benefits that you see coming from that sort of crypto space. So to me, it is the future. And I think as these sort of government-backed sort of stable coins, digital currencies come into the market, I think it's going to start to expose perhaps some of that more speculative crypto stuff is not really being fit for purpose. Hey, debate still to be had, right?
Yeah, I think the issue there is, from what I've seen, the Reserve Bank's sort of talking about a $2,000 limit per person, and so that means there's still a role for other stable coins where you can, in theory, own an unlimited amount. So
yeah.
But JB, you kind of feel like that could be a gateway to innovation, kind of like what we need, right? For the dots, for the wires to finally start connecting between the analog and the digital world.
Yeah, 100%. Look, I think that part of the natural barrier to entry that banks have at the moment is just the massive amount of infrastructure required, in the financial system to run payments and stuff like that. And I think, I think these sort of distributed technologies will change that. So it's a huge positive. Look, I think there's a role that government's really missing out on, more broadly around innovation, and fostering innovation and driving it. The private sector can do so much, but a lot of the good that happens in the world from a technology and innovation perspective ultimately started with governments. Yeah.
I'll tell you who will be the primary benefactor of digital currencies globally. Two companies, Visa and MasterCard. They're connected to every merchant in the world. They have, they can build unique tech for that off a different set of rails from their own payment networks, which are incredibly slow. But they won't let someone else get a bite at that cherry. They'll be thick into it, and I think we're already seeing sort of action in that space. So, and I guess what that brings is a global solution as opposed to just a domestic solution.
Yeah.
So I think there's a lot to watch in that space with the global credit card companies.
And there's trade-offs. So just again, thinking about central bank issued digital currencies now longer term, do you not see, bit of a leading question, do you not see that there's the very least a potential for a centralized entity networked amongst other central banks around the world to use their position of authority over the money that we're forced to use? Don't you feel like there's the potential that could cause harm long term?
You're sounding American.
I'm sounding global, hopefully. I'm sounding global.
Hey, look, yeah, absolutely. But I mean, we're probably diving down a big rabbit hole because we haven't even started talking about AI, right? Look, I think with all of this sort of stuff, you've got this tension in the world at the moment, between the benefits of large scale technology and these massive advances that we've got going on, and the human side of things. And it's happening everywhere, whether it's happening with social media, it's happening with AI, happening in crypto space, digital currencies. It's a sense that people are losing their freedom and autonomy as we move towards these big systems, right? I don't think that conversation is going to disappear anytime soon.
And
I mean, there's a big thing about trust, right? In terms of, is there a global digital currency? Are central banks going to get together? I doubt it. Um,
yeah,
I think private enterprise will sort of do that.
we'll see. Go ahead, sorry, John.
I don't think people will let it. Look, I think freedom is just it's a value and something that people really want. And if you think about modern people, people are looking for more freedom and stuff. They don't want to be reporting to the man. They don't want to be controlled. They do want autonomy. So I kind of feel that we're trading these risks, but fundamentally there's a real human side to this that will ultimately prevail.
The world is going to be more digital in the future, right? And that ultimately
100%.
is the underlying subtext of this conversation, that the world is going to be more digital. Right now, we're too analog. We know that the digital exists, but the digital is being owned by, I guess, separate decentralized initiatives, and centralized authorities are watching that. They're assembling it to create their own. There's two camps. One would be, let's call them the freedom camp, freedom to choose. The other one would be, no, we actually need a government in this digital world, otherwise it's going to be absolute anarchy. And so, yeah, holding those two truths and points of view in tension is not an easy space, and I know because I work pretty hard at that. But it is going to be messy, I'm going to suggest, in terms of from here to there, to get the public on board with it. And so I guess my last question for you would be, do you think that the Reserve Bank of New Zealand, or central banks in general, have a PR challenge ahead of them as it relates to CBDCs?
No, I mean, it's
No,
just like,
no.
who cares, sort of thing. If something makes sense, we use it. If it doesn't make sense, we don't. It's like I always sort of say, we don't. None of us really, hardly in the world, wake up thinking about banking or financial services. We just use shit if it's good. We don't get too anal about it. So, nah.
Yeah, I agree, Dave. I kind of feel that it's a bit like I guess what we're doing now, right? Like Zoom and Microsoft Teams and video conferencing pre-COVID. No one did this stuff. Now we just it's just part of the way we live, right? I think the same is true of all of this technology. I think the big thing for me is I kind of feel that adoption rates are increasing because we're getting more used to it, and digital currency is just part of a much broader thing that's happening with all sorts of tech, sort of infiltrating our lives, right? So
Mhm.
as long as the use case is strong and the experience is good, I think there would be massive and very rapid adoption towards a digital currency.
Okay. Yeah, let's watch this space, because yeah, if we have mass adoption, then it'll be smoother, and that's kind of all I'm interested in, is stability.
Yeah, I just don't think it's a game changer though. But hey,
Right.
we'll see, right? I think we can do most of that stuff now. I can load money onto a card and spend it in any country in the world, and by just tapping it, it's a more elegant use case. But how radically different is it from something that I can do already? But watch the space. I'm
Yeah.
ready to be surprised.
All right. Cool. Thank you so much, guys. We've had a pretty good conversation, right? Like, talking about the different layers of regulation, and I think as it relates to the everyday investor, trademark. Yeah, we know that there's stuff going around the periphery. We don't need to know what the details are. We know that there's stuff going around the periphery in terms of different rules, different innovations, different market participants. People are talking about it, so that's good. There's robust, open debate. And I think the future does look bright for everyday investors and borrowers as well, in terms of property. So, any last words of wisdom or parting comments that you want to leave us with?
I think we're probably getting into a better space where we are starting to pull back maybe some of the overregulation that's occurred. I think the main thing for me is as Kiwis, we all want the same thing, right? We just want a better country. We want a better economy. We're all striving for the same things. We want everyone to feel good and be able to actively participate and stuff. I think it's a pretty tough environment out there right now. People are struggling with the high interest rates. That we could have a whole discussion around inflation, which is, they'd go for hours.
Yeah.
Look, I think the thing for me is I think bureaucracy gets in the way, regulations generally get in the way. We do have lots of unintended consequences. We've just got to be really careful with this stuff. And I think in New Zealand, we rush some stuff and we don't do a good job of it.
That's a really, really good, warning or point to finish on. But one more. I said one more before, but this is the last one. Between now and the end of the year, obviously you touched on it just a second ago there, JB. Like, it is a little bit dark out there. High interest rates. The economy is kind of not looking too good. Inflation is still pretty high. It's still pretty up there. What do everyday Kiwis have to look forward to this year?
Well, I'll start. Hey, look, I think we all know that we've got to go through a little bit of pain. I think most Kiwis accept that, and they knew that something was coming. I guess we saw the early stages of it with house price reductions last year. Obviously, increasing interest rates that people have had to get to. It feels a bit like the light's at the end of the tunnel, but it's just kind of got pushed out a little bit further. I think it's just kind of hold the faith. We're nearly through this. You haven't got too far to go. My view is that, look, it's not the view out there with economists, and me and DC are the same on this, is that I think the economy is weaker than the headlines would suggest at the moment. People are feeling it, but the data, we've had some weakness there. We're obviously in a recession. I kind of feel it's pretty bad. We've still got a bit of inflation coming through, especially in that non-tradables. But my view is that what we're experiencing will come through in the data over the next 3 to 6 months, and I'm confident that we're going to see some level of rate reduction, or at least that light at the end of the tunnel getting very bloody close by the end of this year.
Yeah. Would you speculate, David, around how much the official cash rate might drop by the end of this calendar year?
Well, look, we've been advocating for a couple of months now that the Reserve Bank should be cutting the OCR in May, or in April actually, but the May Monetary Policy Committee meeting's the big one. We'll continue to advocate. What's interesting is economists have almost moved out their time frame to November or February, so most economists are really late in the year or next year. Mm-hmm. I see the data every day, and every read is weaker than expected. I just don't get why economists are sort of singing from one song sheet where I think they're on the wrong song sheet. And JB and I sort of have that view. So we'll be advocating. What you'll see is Squirrel advocating very strongly for the Reserve Bank to ease monetary conditions for the good of New Zealand and New Zealanders, both depositors and investors.
Mm-hmm. I like that. That's good. Cool, guys. All right. Well, now, where do people go if they want to learn more about Squirrel?
Oh, jump on our website. There's a ton of stuff up there. We've got quite an active blog. So www.squirrel.co.nz.
Cool. Awesome. I'd definitely encourage people to subscribe to the newsletter. Lots of really good opinions. Facts are great, but opinions, that helps contextualize it. So keep up the good work, guys. Love it. All right. Thanks very much for your time today. We'll catch you in the next one.
Awesome. Thanks, man.